A warm welcome to everybody out there to our next webinar here at JFD Brokers. Also, in the name of JFD Brokers, a warm welcome as well. And yeah, my name is Stefan Friedrichowski. As always, for those kind of webinars, this specific hour of the day, and yeah, the weekday is also always the same. Today, yeah, we have the 12th of July, 2018. So more than half a year is already over. So, but anyhow, today's topic is daily seasonals in the forex market. Oh, sorry. 1 second. Sorry, I'm back again here. Daily seasonals in the forex market. Seasonals, we have had already such a topic when we talk about our day of week seasonal for trading DAX. And today it's about forex markets in general, or in general all kind of markets. Later you will see that we even can touch so-called Bund future or Brent or whatever. It's always the same. We look for seasonals, but we do not look for seasonals in the sense of a specific month or even a specific quarter, like springtime or December or May or something like that, because I don't like that kind of approach. The reason is simply because always the statistics is quite poor. If you think about, we go for months of the year, and you go back for 10 years history of data, then you have 12 times, for example, December. And even if you go for 20 years, then you have 20 times December. So from statistical point of view, that's not a good statistics, and therefore I don't like those kind of statements about seasonals. But if we go for daily seasonals, the picture changes, because now we have, for example, if we go for Monday, then we have 52 Mondays a year. In 10 years already 520. So now statistics can play a role, and that's much better, and that is what we will use. And therefore, I specifically like those kind of daily seasonals, because it reflects a little bit what happens during a week. Maybe the Monday has a specific meaning for specific underlyings, or maybe the Tuesday. It might be related to news, because typically specific news are always at the same day, but we don't care, because we look for the price changes and we try to find common conclusions for a specific underlying, and that's exactly what we do here. And yeah, that's daily seasonals. And one other remark here, because we have had a similar topic 2 weeks ago, and I at that point in time I already said the two webinars are in the wrong order. Today is, let's call it the first one, and the one for 2 weeks ago has been the second. It was my mistake, but maybe now things become a little bit more clear than 2 weeks ago, because what we have here are the real basics for daily seasonals. As always, you can already download the slides if you like, and simply by going to your GoToWebinar control panel. I've uploaded the PDF document already, and later we have a couple of Excel sheets once again. If you're interested in those, just send me an email and I make sure that you get them in the two formats, Microsoft Excel and LibreOffice. The other thing, as always, I have to mention the risk disclaimer, because we talk about specific trading strategies. And if you finally trade, it may be exactly those kind of strategies. You trade simply for your own. I think that's, as always, self-explaining, and it's always your own responsibility for your own trades. A little bit more in detail, we will once again, as 2 weeks ago, we will start with that Friday gold rush. But now, today, we will really demonstrate exactly that Friday Gold Rush. Friday Gold Rush simply stands for the observation that on Fridays, price of gold typically went north. And a couple of weeks ago, Andre Stagge has made a webinar exactly for that. Therefore, I have referenced a little bit to Andre Stagge. But as far as I know, he is not the inventor of exactly that kind of observation. But anyhow, I would like to mention him here. What we will then do is we will really start from the scratch. We start with a plain, an empty Excel sheet, and I will quickly, and it only takes 5 minutes to establish an Excel sheet which really shows that kind of statistics. And we are already then prepared to investigate any other underlying, and I will demonstrate how quick and easy you can do those things by your own. Therefore, I call it simply a minor Excel exercise here to establish that kind of statistics. And then we go back to real trades with stop loss and everything, because then we go for the daily strategy. Everything today is on a D1 chart, on a D1 base. We will open our trades at the beginning of the day, and we will close those trades at the end of the day. So formally, still those trades are intraday trades, and you might close those trades even an hour earlier to avoid swap costs, but that doesn't change the overall picture. That kind of generalization, complicated wording, sorry, we will do in Excel once again, and I have prepared something that you can do anything for any underlying simply by your own. And finally, since I'm not only related to those Excel sheets, I have investigated that kind of strategy much more in detail. With walk forward methodology, for example, I will show you the complete portfolio based on two assumptions. Okay, the Friday Gold Rush. You remember we have had that chart 2 weeks ago. And of course, it's more or less, illustrating the statement by its own, because that blue line simply goes north, and that illustrates that on Friday, you should go long with gold, and that's all. But how can we do something like that by our own and really quickly? So we would start always with the data sources. And I mentioned here 3, Yahoo Finance for daily, Dukas Copy you can use for daily data as well. And for daily, you can use that strange sound, that strange name stock with Q, stock.com as a data source for daily charts or daily historical prices. I have to mention one additional point here, because if you go for Dukas Copy, for example, and you would download D1 data there, then you will realize that you have to shift all the data by one day. It goes back to the original data source of Dukas Copy and the time zone they belong, and therefore everything has to be shifted by one day. As always, if you go for historical data, just do a cross-check with those data, and you will easily realize about the weekends. So just as a remark, if you go for D1 data, download it at Dukas Copy. All the 3 sources are free. You don't have to pay for anything there, and you can get those data. Our task here for that Excel exercise, I will demonstrate just in a few minutes, is that we want to derive whether the specific days of the week have a specific edge. So like that Friday Gold Rush. And that's all. We just ask ourselves, are specific days of the week, do they have a bias in a certain direction? Maybe north, maybe south. And that's all. If so, we are already on a good path to a new trading strategy, because, as you know, we need probability advantages in order to get a profitable trading strategies. Without that advantage, we would fail with our trading strategy. So that's one base. And even that one is not enough. Later we will see that there's another day of the week which goes south for gold. And even that going south is not enough in order to be transferred to a profitable strategy, trading strategy. Reason? Costs. When it comes to commission and spread, then our advantage is not big enough in order to be profitable. Mention we go for Excel. So in order to get our strategy, so we really start with a plain empty Excel sheet. Okay, now we need data. No problem. We go for data, and I go here for this stock.com, and it's quite easy. We want to go for gold, so symbol is this one here, and then we can download the data quite easy. Historical data, and then you see you could even download data from 1793, which is really a long-term history, but it's not really filled with all the days. I always go for, right now, for 2000, starting with that number, and then I can download the data, and then I can open those data here directly in LibreOffice. And the good thing why I use LibreOffice, because the import functionality from LibreOffice to get those data into your sheets is much better than with Excel, because if you use exactly those kind of settings here, then you can transform and read any kind of date and time and the different kind of separators and different kind of decimal separators. No problem. You can read everything. So now we have the data, and let me make it a little bit larger here so that you can see it a little bit better. So of course that are the price of gold, and we do cross check here whether everything with the data look fine. And just plotting the data, then we have something which looks like this, and you see, okay, looks good. That is the gold chart we are used to. Of course, we want to know the day of the week, and there's an Excel functionality. It's simply called a weekday, and then we get our date transferred to a number, and that number you will see is a number, in this case between 2 and the maximum is 6 in this case, and it just stands for 2 is Monday and 6 is Friday. The two missing numbers is Saturday and Sunday. That would be 1 and 7. And then we have the day of the week. We will use that kind of information just in a minute, because we want to investigate all the different days, Monday, Tuesday, and so on, independently. Okay, and what we will look for is a change. The change in percent. So, and with change in percent, I simply mean, the difference from close of the day minus open of the day divided by open. So that is a percentage change at a specific day, starting here with 0.3% at that day, next day minus 1.5, and so on and so forth. So that's all. We look for percentage changes and not absolute changes, simply because everything is relative. So at a level of $300 for gold, $10 would have been already a big increase or big change. At $2,000, $10 would not be that much. So therefore, we do everything percentage-wise. Now we are interested in those 5 days of the week: 2, 3, 4, 5, 6, exactly Monday up to Friday. And what we want to differentiate here is that we later can sum up all the changes of Mondays, all the changes of Tuesday, and so on. So we have to ask, is the current date exactly the one we are interested in? So that's exactly that kind of comparison here. And if so, then we would like to see here the change of that day, and otherwise we put a 0 here. And that's not totally all, because we want to copy that cell to all the other ones. Therefore, we have to mark a few things with a dollar sign, and in order to be prepared for that copy process. So we need dollar here, we need a dollar before that number, and finally we need a dollar here, so that everything moves well when we copy everything. So, and now we have exactly what we want to have. The next day here, it's a Tuesday, we have that number here. For Wednesdays here, and so on and so forth. Yeah, and now we simply go for something which looks like an equity curve. So we want to sum up all those changes systematically, and we start with the first day. So there's nothing to be summed up. And for the next day, we have to add everything to the previous day, and we go here as well. And then we are nearly done with everything here. Now we go for everything is now summed up through our complete 18 years of history, and then we can plot that against the date, and then we can look for statistical edges. So now we need not lines, this one, and let me label those right, and then you see immediately that we are already completed with our statistical analysis. That's all. I think it took me maybe 5, maybe 10 minutes, and then we have a nice tool to investigate statistical edges based on the day of the week. So let's look for what we have here. So you see that, oh, my labeling didn't work well. Let me change that. And then we can draw our conclusions. Change chart type. That's correct. Anyway, we still know which one is which. So let's directly jump to the brown one. Brown is 6, brown is Friday, and there we have the statistical edge for gold. You see that summing up all the changes of Fridays is a line, a curve, which goes north. That would mean if you would trade every Friday long, that line more or less would represent our equity. And looking for that nearly straight line, hey, that's really a nice statement to have that straight line. Think about your equity of your trading account. Not that bad. So if we can transfer that line to our trading results, great. Then we have one extra element for our overall trading activities. So that looks already promising. But we have another line here. Let's go for Monday. Monday is blue. That goes south. what does it mean? Okay, in terms of an equity, it doesn't look good. Nobody want to trade something which goes south. But the good thing is we can invert that sign simply by going short. So that blue line is already a hint. Monday might be a good short day for gold. Interesting. And the 3 remaining days doesn't look that good. So they don't have a real preference. And so what we have here is, okay, we have replicated the analysis for Friday Gold Rush. We already see another hint that Monday seems to be a short day. So those kind of statements are already extremely valuable. Even if you don't think about systematic trading activities like what we do later here, and that we really go with long trades, with stop loss and so on, you might use that kind of information for any other trading idea. Even if you go discretionary, then you might look to the gold chart on Friday, and you might look for good entry points for a next trade on gold. My statement here would be, or my recommendation would be, look only for long trades, because then you have that statistical bias behind you, with you, that gold has a tendency to go north for increased prices on Fridays. And you would do exactly the opposite on Mondays, because you know from that kind of analysis, hey, looks like there's a preference going south. I don't ask the question why. And especially for gold, you might have some other statements why the price goes up on Friday. I don't care about why. I only care about the statistics. And that kind of statement I can have here directly in a few minutes for one underlying. And that you can see that it's that easy to get those kind of analysis here. Let's change the underlying. Let's go for something else. Let's go for the so-called Bund future. That is a symbol for that. No, not this one. GG. Now you can see here Euro Bund, and that's the Bund future, the German one. And we can download the data here once again. Let's go for data starting from 2000, and let's have a look on those. And in a minute, I will do one additional example. Let's go for those kind of data. Just open them in Excel. Then we copy the data to our already existing Excel sheet, and we are almost done, because you see, oh, the chart doesn't look that good. We have still some gold prices here. So that's the last couple of lines here, and I will remove those. And then we only have the Bund future within that kind of analysis. And here we are. So what you can see here is, once again, those kind of statistics. And let's quickly jump through it. So you see in blue, Monday, that blue line. Okay, it's not that straight as gold on Friday, but still not that bad. So we can have the Bund future as a long trade for Mondays. The other days, the green one doesn't look that does look as well, quite well. So that's Thursday. On Tuesday and Wednesday, there's no real trend, so we would not go for anything like on those 2 days. And to have an additional one, which is a little bit more impressive, let's download data for oil. And let's go for Brent. That's this kind of symbol. And we could download from from 1983, but we go once again from 2000, and have a look here. What's about statistics on that one on Brent oil, and you see it only takes a few minutes and to draw those kind of conclusions we are really interested in, because that kind of statistical edge can help us quite well for any trading activity. Let's have a look here. So now, hey, good thing. The blue line, which is Monday, goes more or less straight south. Great. So oil is a short candidate on Monday. Good thing. Now we have already a good thing on Friday with gold, very good thing on Monday, short now with Brent. Great. That's exactly those kind of statements we are looking for in order to enhance our trading. And even Thursday doesn't look that bad, that going north. Why not? So that day might be a good day for long days, for long trades. And once again, you can use that information even for discretionary trading just to have a bias. Normally, you look to a chart and you ask, hey, should I go long? Should I go short? Now you have at least the statistical edge on your side. And that's great. So that helps already for any other kind of trading activity. So that's a way, easy Excel exercise to go through a number of underlyings, and it only takes you per underlying a couple of minutes, and then you can have all those statements. But now we want to go a step further, because we want to use that kind of information and translate that into real trades, because a statistical edge is not normally enough for a profitable trading strategy. So we generalize now what we are doing here. So we will investigate really as a trading strategy, including spreads, and we will investigate separately the different days of week, Monday, Tuesday, and so on. So 5 times. And of course, a specific day might be a long day or a short day. We can investigate. We can play around with that. Okay, still now we have 10 combinations, and I will increase that number further by a factor of 2. But that's for later. We will go for a few real degrees of freedom. We want to place a stop loss. That stop loss we will place in percent of the open of the trade. Good. And we can change it, of course. We might go for 0.5%, 1%, 2%, whatever. So that are the real degrees of freedom. And as the previous webinar 2 weeks ago, we will introduce an EMA as a trend filter. Think about in terms of, hey, okay, price is above a certain EMA. I only want to go for long trades and nothing else. If the price is below that EMA, I will simply not trade. Doesn't matter. That might help us a lot, especially if you go for something like indices. If you go for S&P 500, think about, okay, we might come to the conclusion that Thursday is a good long day for that index, for that index. But now the market breaks down. Okay, no problem. If we cross that EMA, if we are below that EMA, we would not trade. Good. So that kind of filter helps us even to further improve our strategy. But now the question is, we can do it a little bit more complex. So still, as I mentioned already, intuitively one would always state long trades only if the price is above that EMA. Okay, I would agree intuitively, but sometimes intuition is wrong. So let's keep it open. Maybe we can do exactly the opposite. So if the price is above the EMA and we are investigating a short strategy, yeah, that's now our starting point. So it's then a little bit more like a reversal strategy. Price is above the EMA, and maybe we find underlyings with a tendency to say, okay, go back into the direction of that EMA. So therefore, I call it reversal flag. And that finally gives you, if you go through all the combinations, gives you 8 different possibilities. Having that in mind, we can go directly to our Excel sheet and investigate real trades now for specific days of the week. Okay, here is that Excel sheet, and as I mentioned, you have access to those as well. Just send me an email. Email address comes later on my last slide once again. And you can play around with different underlyings, different values here. And let me quickly guide you what I have done here so that you understand a little bit more how that Excel sheet works. I know everybody is already now looking to our equity curve here. Okay, equity here for starting at 2000 is in units of R. So that's the risk unit. That's exactly the stop loss value to, yeah, I think that's maybe the best translation. Let me give you an example. Think about price of gold is at 1000 and you place your stop loss 1% apart from the open of your trade. So 1% from 1000 is 10. And if you go for a long trade, you would place your stop loss at 990. Okay, now the next question is how much money you would like to risk for the trade. Okay, maybe you say $100. Now you can translate that $100 and with a stop loss of 990 with the number of lots you can trade. It would be maybe, I'm not doing the calculation right now here. Maybe it's 0.05 lots. Okay, so we know if we have a certain risk value and a certain distance for our stop loss, then we always can translate that in the lot size of our trade. Always that kind of calculation you should do always in any trading activity. If that trade would touch our stop loss, okay, then we would lose exactly our risk. For in my example, the $100. Good. So, but if we go $10 upwards and close trade there, then we would profit $100. And that's talking about R, that risk unit R. It's exactly the amount of money you risk with any trade. It would be the profit in the other direction. That means if we have here a number like profit of 50R, it means if you go for $100 per trade, then we would profit $5,000. So you can translate always that number in real currencies, just multiplying with the risk per trade. So that's the y-axis. The x-axis is self-explaining. It's just a date. You see, as always, we have a lot of statistics here, number of days, the sum of our profits and win rate, and so on and so forth. Later, as in previous webinars, we would look for what I call opti, and we want to minimize that number because the smaller that number, the better the strategy. But now to how we do everything here. Everything starts quite similar to our pure statistical analysis. We go for the day of the week and we have the same kind of numbers here. And later we can switch simply by selecting 5 or 2 or whatever. We have an EMA which is calculated here as well. So we can change the EMA period directly here. And we can ask ourselves, do we look for a long strategy or a short strategy? If you go for a long strategy, then every trade will be a long trade. And if you change it to -1, okay, then everything is a short trade. Later, I come to once again to that reversal flag as introduced already on my slides, and that flag EMA on and off. Off is that 0. So I come to that once again here. What you can change is finally, if you want to optimize a certain sub strategy, and the sub strategy is specified by the day of the week, specified long or short, and specified with reversal yes or no. Your degrees of freedom to get that strategy up and running is then finally only changing EMA and stop loss. And you might do this with that Excel solver functionality in order to optimize your strategy. In principle, you can use take profit as well with that. Let me change it to risk reward ratio. That is here set to 100, which would mean you will never touch our take profit. But in principle, we can introduce take profit level here as well. So the trade itself is quite easy. So we look whether we are above or below the DMA, and if we are at the right day, and if we are with the right condition with long and reversal, then we might open a trade and we set a stop loss, we set take profit. Then it comes that we look, is during the day our stop loss being hit? If so, okay, trade is a -1 R trade. As the second one here, there we have that -1 R trade, because for that trade we hit our stop loss. Okay. Anyhow, the other trade here is has not touched the stop loss. Therefore, we have in this case even a profitable trade, and everything is calculated in that risk unit R. Well, so now let me change a few numbers just that we see how everything works here. So we might go for another day of the week. We might go for 3, which is in this case Tuesday. Doesn't look that good. 2, interesting. Equity goes south. Okay, it's not that astonishing because our pure statistical analysis showed us already that on Monday we have a preference for short. Okay, therefore that we have here an equity which goes south is we can understand. So okay, then let's change trade direction from long to short. And now the disappointing thing occurs. Even we have that probability advantage for going south, we cannot get it as a profitable strategy just by reversing the trade direction, which should be the case, but it's because of the spread. Let me change the spread and let me change stop loss. Then you see, okay, it's a little bit better, and we might go for a different EMA, and it's getting once again a little bit better. Yeah, but still we cannot get it really profitable, and still we have to go back with real spreads of the word, and then it will not be profitable. The good thing is we have other days of the week. So we can go, for example, once again back to our that is Thursday, and this one. Oh, let me go back to Thursday again. Still, we have the situation short trades. Okay, something we should investigate further because. And I make already the remark here. Later, you get for any underlying lots of examples in one table with the right parameters, but still you can play around by your own, doing some analysis like this one here. But you can have access to the complete analysis from my end here. So Thursday, short, doesn't look so bad, but we know we can do better. Let's go for Friday, and once again, we go for long trades on Friday, and yeah, right now we have a stop loss of 3%. Maybe we go down to 2%, even further down. You see, we get some more profits here in terms of R's. If we would only look to our optimization number, Opti, then this one here would a little bit better as well. And maybe we can change to other EMA values. And you see, the good thing is the picture doesn't change that much, which is good, because if we can change our parameters for EMA values and stop loss values, and the equity is still good, that's a good indication of a stable strategy. What we can do here as well is we can simply switch off the EMA. So if I put it in the 0 here, then we don't use an EMA anymore. Strategy might look better for the one or the other, but it's worse. The reason is the drawdown. And I can quickly realize that by an increasing value of Opti. So the drawdowns without an EMA filter are higher. The slope is not that bad, but now as a proof that you can change the EMA value and it doesn't have an impact on strategy simply because EMA is switched off. So we don't use anymore the EMA. I put that into that Excel sheet as an extra functionality so that you can really have different views on different underlyings. So finally, it doesn't look that bad if we switch on EMA, and we might go for something like this one here as a good strategy. I summarize all the numbers in one table later. What I want to do here is I want to invite you just to do something similar by your own, simply because what you do here helps you to understand your strategy, helps you to come to better conclusions, and even to see, okay, even if I have something like this, which is really not bad, I still have drawdowns, and you see those in your equity. The final clue is, of course, to combine lots of those strategies to a complete portfolio. I come to that as well. But now, just that you have an impression, does it only work here for gold? I have even better examples. Let me change underlying. Let me go for Canadian dollar, Swiss franc. And here we have a very good situation for Mondays with an EMA of 13. Now it's a so-called reversal strategy. It's a long strategy, but we only open our trades if we are below the EMA. So we reverse that picture, which has been intuitively always a 1, but why not going for a -1? So why not change our perspective here? And with a stop loss of close to 1%. Doesn't look that bad. So Opti is already below 1,000, which is really good. And if you do something here by your own, don't forget to change the spread. If you would still have the spread here being for gold, I can show you what happens. Then you don't have a good strategy. But of course, we don't have spreads of 0.2 for Canadian dollar, Swiss franc. So that's the Monday strategy. It's a long strategy for Canadian dollar, Swiss franc, and it's a reversal one. to see what is the impact of the EMA, we can switch it off, and you see it's good to have that EMA as an additional filter within our strategy. Last example here, Euro US dollar, also not that bad, going north. It's once again a Monday strategy, but now it's a short strategy with reversal, meaning we would go with our short trade if we are above that EMA. Tight stop loss of 0.5%. And then we have one additional strategy. You see, that really looks like a portfolio. It's not a single underlying only which we can trade with that kind of logic. Of course, every underlying has different values. Why not? Why should gold behave exactly the same like the DAX or Canadian dollar, Swiss franc? There's no reason that those different underlyings should be traded the same. Therefore, we can do it individual for any underlying. I mentioned I have summarized already all those results for a couple of underlyings and the specific days of the week. Let's go for that as well. So I have investigated indices, commodities, forex pairs, and don't worry that you cannot see within that table anything. Within that Excel sheet, then you can read everything. What does that Excel sheet contain, or what are the numbers there? Every line later is for one strategy. It's a specific underlying, a specific stop loss value, EMA period, the day of the week, and of course that reversal flag being plus or minus 1. And within that Excel sheet, because I have all the Excel sheet itself is only the summary of my investigations via my self-written C code, and within C, unfortunately, I have another number for the days of the week. So now one is a Monday and so forth. By the way, that is a typical one. Excel is the exception here. Just that you know, 1 is now the Monday and 5 is the Friday. I promised that we have a look here as well, and here we go. That's the equity of that portfolio, and that portfolio is trading in total 66 sub-strategies. How to read that table? Let me go for an example like this one here, just as an example. So we are talking about Australian dollar, US dollar. Good. Then later you see LS1 means it's a long strategy. We do that on day number 3, which is Wednesday, and without reversal. So reversal flag is 1. We use an EMA period of 9 and a stop loss value of 0.9%. That's all. That's one of those 67 sub-strategies which are profitable. And you see, you have lots of examples, and you may sort that table according to the day of the week. Then you see that we have a couple of strategies for each day of the week. Not every underlying works on every day in every direction, of course not. But now you see we have 18 strategies for Monday and about the same number for Tuesday, and so on and so forth. And that's a real portfolio. And what you see here is an equity which is really looking good. In this case, every trade is, because you see on the y-axis the euro symbol. I have translated already everything to 100 euro trades. So the risk per trade is 100 euro. That's a quite profitable strategy here. And with that you have that number as well. the drawdown within what you see here is 5,200 euros. So that's all. So we don't need that huge trading account to do that strategy. It's really looking well. And for those who are a little bit longer with those kind of webinars, in this case, the optimization has been done for the complete period of history in one step. Still, I have looked for a huge neighborhood, so a huge number of neighbors for those parameters, which means if, for example, an EMA of 100 works, then of course 110 should still work, 90 should still work. Stop loss might be the best at 1%, but then still with 1.1%, strategy must work as well. Only those which pass that stability test are part here. But it has been an optimization for the complete history time we have within our data. But I have done one step further, just that you see that this strategy is really doing a good job. So that one we have had already, but now we can do what I call the walk forward methodology. So we do optimization in a certain history time frame, time window, and then we apply our parameters to the upcoming future, maybe for the next 1 month. And so in this case, the optimization is a different time period, time window than the one we apply our parameters. So the good thing is that is exactly what we would do if you go live with a strategy like this. We have done some certain optimization, and from tomorrow onwards, we trade that strategy. So let's walk forward. I've done a couple of webinars specifically for that topic as well, and you find them on the JFD YouTube channel at the JFD. I only show that graph here that you see even with what forward methodology, strategy still works quite well. It's not as good as before, but I want to share that with you to have a proof that it's not an overfitting procedure that have created that good portfolio. We can really do it, and we can redo our optimization every 1 month and apply those parameters if you like. That's the way how I will trade exactly that strategy. And it looks quite well, I know, and therefore that is now since 2 days it's running, starting on a demo account. As always, I start with a demo account, and I think in a couple of weeks I will share with you the results of that strategy. Just looking for 2 days, it's not enough. I think even the 2 days are positive, but anyhow, that doesn't count. Let's not judge any strategy after 2 days trading history. That would be not the right thing. Okay, so in a nutshell, we know how to derive that statistical edge. And we know that if we have such an advantage, it's extremely valuable. It helps us for discretionary trading or for systematic trading like what we have established here. And the good thing is if we consider all the days of the week separately, we can find sub-strategies for each day of the week. So we create instantly a very broad portfolio of strategies if we look for quite a lot of underlyings. And if we trade those with a suitable stop loss and an EMA filter, then we find very good individual strategies, but an even better portfolio for all of them. So daily seasonals is a good thing, and I've started a few things more already on daily behaviors because it's that promising that I can combine the daily aspect, the week of the day, with other strategies as well. And that kind of combination looks good. Once again, if you are interested in the Excel sheets, I will send them. Once again, it will be a Dropbox link because for emails, the sheets are too big. But anyhow, you will have access to those. Just send me an email to s.friedrichowski@jfdbrokers.com, and yeah, I will make sure that you get those data. We have one step more here with dailies. Okay, our portfolio is increasing and increasing. Looks good. I hope you enjoyed the webinar, and hopefully we see ourselves back in 2 weeks from now. And then it will be about pullback strategies, similar to our stock one, but now a little bit more in depth and not only related to stocks, forex, and everything we can trade as well. Interesting topic. It's a little bit of a good strategy, which is by its own already interesting. So stay tuned, and hopefully see you back in 2 weeks, and enjoy your evening. Bye bye.